Hey everyone, this is Lonnie Matthews coming back at you. This is the second part of the mutual fund discussion that I've been doing. And as promised in this video, I want to talk to you about specifically how a mutual fund works. So in the last video, I kind of touched on what a mutual fund is and just do a quick review. Remember, a mutual fund is a collection of individuals who mutually agree that you want to invest in a specific type of set of companies, and then they pile all this money together and they turn it over to what we call a fund manager. That's an individual that manages the fund, and then they have analysts that work for them, and those analysts their job is to identify the best companies in the best industries that are going forward that meet our mutual criteria. And then they kind of go out and invest the money for us. I also said that they have an opportunity to talk to the management of companies and things like that to see how they're doing and what they're doing, as opposed to, one of us trying to go and talk to the CEO of, Amazon or Netflix. It's probably not going to happen, right? So then they invest the money, they get their the great returns on the money, and we all benefit from it. So that's kind of a mutual fund in a nutshell. So when you're buying shares of a mutual fund, you're buying shares of this pool of money that's already been invested for us. So what I want to do in this lesson is talk a little bit more about the logistics and details of mutual funds. And let's get down to the nitty gritty. So this video may be just a little bit longer than some of the previous one because it's some good information, and I want to make sure that I get this information to you so we can move on to discuss something else. So again, in this lesson, we're going to talk specifically about how mutual funds work. How mutual funds work. So what I want to do is talk about a specific fund. So right here, you can see this is this fund called the Growth Fund of America, and it's through a company called American Funds Capital Group. Now, let me go ahead and go into full disclosure mode right now before we get too far into this lesson. And as always, past performance is not indicative of future performance. There are no guarantees when you invest your money in the stock market. In fact, before you invest, I recommend that you seek the advice and help of a competent advisor to sit down with you to help you sort out what your risk tolerance is, what you can stand, what you can't stand as far as the market's concerned, and to be able to hold your hand through this process. So in other words, seek an advisor and continue to educate yourself on this. This is not a recommendation for this particular fund by any way, shape, means, or otherwise. The only reason I chose this fund is because I own this fund and I've owned it for quite a long time and just bought shares, sold shares, bought shares, and sold shares. So that's why I chose this fund for no other reason. So this is not an endorsement for this particular fund. So again, this is the Growth Fund of America. It's through the American Funds Capital Group. This fund has been around for quite some time. I mean, really the lifetime of this fund spans at least 70 some years in existence. So this fund was around when the Great Depression was started, and it has consistently done fairly well. So that's the American funds. Remember, I said when you purchase mutual funds, you are purchasing a pool of stocks. This particular fund, as of the day that I'm doing this, has about $165 billion under management. $165 billion. So a lot of people have pooled their money together. And this allows this fund to go out and purchase major shares of stocks in some of the most well-known companies. So as you can see right here, what I did was I went to this prospectus. By the way, all mutual funds have a prospectus. I encourage you to download the prospectus. That gives you all the details about the fund, how it works, who's running it, what are the costs to run this fund. All that information is in your prospectus. So if you talk to someone and they don't give you a prospectus, then they're violating the federal law. So you need to get a prospectus. But when I looked at this prospectus, as you can see here, these are the top 10 holdings in this mutual fund, the top 10. There's only 9 here on the screen, but the number one holding is this mutual fund has about $13 billion sitting in cash right now in a cash account. It's earning a small amount of interest. That's protected investment. They allow them to be able to move on a particular company if they see it doing well. So this company has about $13 billion in cash, but right after that, these are the most notable companies, or the largest percentage of this company. So you can see they have Netflix on here. They have Facebook, Microsoft, United Healthcare, Tesla, Amazon. Amazon's selling for about $2,000 per share right now. This particular mutual fund right now owns about 4 million shares of Amazon. Now imagine you trying to go out and buy 4 million shares of Amazon at $200, $2,000 a share. Right now, they've invested about $8 billion in Amazon. So every time Amazon makes a move, or any of these companies make a move, then you'll see that the value of this mutual fund grows up. So you got Amazon, Alphabet, that's basically Google in them, Broadcom, and then MasterCard, that's the servicing company that actually processes the MasterCards. That's an actual company. So these are some of the top 10 holdings. All total, this mutual fund has about 354 companies in it. 354. So imagine when you buy a share of this mutual fund, you're buying in ownership in not only some of the top companies in the country or in the world, you're also buying in 354 companies. As of the day that I'm doing this particular presentation, this mutual fund is selling for about $46.72 per share. $46.72 per share. So you automatically, every time you spend less than $50 to buy some shares in this particular company, you're going to get your money spread out over 354 companies, and you get some of the best known companies in the world: Netflix, Facebook, Microsoft. So that's where your money is being spread around. So now that we've kind of talked a little bit about this particular mutual fund and kind of where your money is going to go and what your expectations should be when it comes to this fund, I want to show you right now how this whole thing works. And remember, I said that mutual funds will allow you to get in with small amounts of investments, meaning you don't have to have a whole lot to begin with, right? You can start with just a little bit, and that money will grow over time. And that's the neat thing about mutual funds, and that's the beauty of being able to just get into the market without having tens of thousands of dollars. And this is why I love mutual funds. So as you can see here, let's pretend that you had $1,000. We're going to go back in time. And so we're going to pretend that in January 1st of 2010, we're going to go back 10 years, January 1st, 2010, you had $1,000. You decided that, hey, I want to invest $1,000 into the market, but I don't know where. So I think I'm going to go with the mutual fund. And you happen to choose America's Growth Fund of America. You also decide during that same time period that, you know what, I can add an additional $100 a month to this mutual fund. So January 1st of 2010, you invested the initial $1,000. Now, this particular fund, I got to be honest with you, you got two types of mutual fund. You got those no-load funds and what we call loaded funds. And this particular fund, you've probably never heard of it because you can only buy it through a financial advisor. This is what we call a loaded fund, meaning they're going to take 5% off of the top for that initial investment, right? But what that does is it gives you the opportunity to sell that investment at any time, no matter when, no matter what, right? And that pays the financial advisor. A portion of it goes to pay the fund manager and things like that. So if your initial investment of $1,000, you really only invested about $995, right? They had to take 5% off of the top to be able to run the fund. And we'll get more to the fees here in a little bit. So you actually invested $995 in this particular first investment. And then every investment after that, same thing, you invest $100, so you invested $95 into the fund. That's a loaded fund. A no-load fund means you will put that same amount in. You invest $1,000, they're going to invest $1,000 for you. But you have to watch out. Some of those no-load funds, they have a back-end charge, meaning you can, when you try to sell it within a certain number of years, then they'll get that cost back from you. Just make sure, again, when you sit down and talk with someone that you ask these questions, whether it's loaded, no loaded, and things like that. But in this particular investment, as you can see here, as the slide comes up, so you invested $1,000 and then you added $100 a month to this particular mutual fund, right? And you did that every month. And at the end of the year, you can see here that you will have invested about $2,213. You can see on that column there. That would be the value. You invested $2,100 in the fund, but it had only grown to about $100, right? That was, if you remember back during that time period, 2010, that's right when the economy was recovering from the bubble bursting of the 2008 housing market. So we were only about 2 years away from that. So the market really didn't do well during that time period, but it did do something. And at the end of the year, you owned about 73 shares in this particular mutual fund because the money that was made, that dividend income, was reinvested. Okay. Now, the second year, if you can look at this thing here, you added another $1,200 to this particular mutual fund. You got about $25 in dividend income. Dividend income is where the stocks inside the mutual fund pays a dividend out to the owner. And because the mutual fund owned the funds, owned the stock, owned the particular stock, then they just distributed that money to you, the person that owns the mutual funds. Now, you will get a 1099 at the end of the year for that little bit of money that came to you, that $25 in the second year. That's the cost of investing. I mean, unless this money was somehow into an IRA or something like that. Now, as you can see, there are no capital gains. Capital gains is where the actual value of the mutual fund goes up because of the price of the stocks that's in the mutual fund goes up. That's like when I was saying when Coca-Cola goes from $45 a share to $46 a share. That $1 that you gain, that's the capital gain. So that money you also tax on as well. There's no free lunch in America. So now as we can go down this list here, we continue to look at this particular mutual fund, you can see year after year, you added $1,200 to this mutual fund. And then each year you had some dividend income and each year you had some capital gains income. So you can see here, it wasn't until year 4 that you actually had some capital gains. So that would be in 2013. So the market is starting to pick up a little bit at this point, right? Now, remember, all you're doing is just investing your $100 a month now. It's on autopilot. It's coming out of your account each month. You moved on. You forgot about it. But you're building up and you're building up. So you continue to do this year after year after year. And then finally, in January 31st of this year, 2020, the value of your mutual fund is at about $26,169. $26,169 over a 10-year time period. Now, I don't know about you, but wouldn't it feel good to be able to have $26,000 just kind of laying around that you can use for whatever? My wife and I did the same concept during the same time period, and we were able to cash in that mutual fund to turn around and put that money down on some rental property that we now owned, right? That we now own, where we have a renter coming in and they're paying the rent to us every month. So we just basically leverage one investment for another investment. But the biggest thing I want to bring to your attention here while we're looking at this chart is this. Look at the column where it says total amount invested. So as you can see, yes, your account is at $26,169, but you actually put $13,000 of it in there on your own, right? That's your money. The difference between the $13,000 and the $26,000 is the benefit that you got for investing your money in the mutual fund. So during this 10-year time period, you got about $674 in capital gains. Dividend income. And then you got an additional $7,563 in capital gains. That's the growth that took place from the stocks inside the mutual fund. So what am I saying here? I'm saying here the key is you just got to start saving money. Mutual funds is not going to be the great savior, right? And there's nothing sexy about mutual funds, but what it does is it enhances your saving. So the key here is you listening to this video have got to start saving. That's the thing. So even if you didn't put it in a mutual fund, you still would have saved about $13,000 in that 10-year time period. But because you put it in a mutual fund, that $13,000 is now worth $26,169. And then you actually ended up with 507 shares at the end of that time period. So you're asking, well, Lonnie, how do I end up with so many shares? Because what's happening is rather than taking this capital gain and the dividends each year, at the end of the year, they're going to purchase more shares for you. So that's how your shares end up going up over time. So between you saving and between you reinvesting the money that you made into additional shares, and as those additional shares continue to go up in value, so does the overall value of your investment in your portfolio. Now, remember, you could sell at any time. Let's just say, we're down here in 2017. The investment is worth about $18,000 or so. If you need to pull out 5 or 6 to do something with, that's certainly your right. Mutual funds will allow you to do that. Remember, I said in my previous video that if you sold on Monday, you probably have the money in your account no later than Wednesday, if not Tuesday. So they just need to wait to see what the value of the mutual fund is at the end of the trading day. And that's how mutual funds work. They're not sexy. A lot of people want to get into the market, but you really don't have an understanding of how the market works. This is a low cost, low key way to get into investing by doing it inside of a mutual fund. And then the fund managers manage the money for you. In this particular fund, the fund management team has an average years of 27 years in the business. They're medium years. That the guys with the least years on the team and the guys with the most years on the team, you take that, they average about 27 years of experience. 27 years. That's a lot of years experience to be able to manage this money. And I rather have them do it rather than me with my limited time and or experience to sit down and try to figure this out. So that's how actual mutual fund work. But again, I want to encourage you to do your homework, do your studying, go online, Google, whatever you got to do, sit down with an advisor before you jump all the way into this investing things. So that's it, guys. Hope this was beneficial and good luck to you.